there's a huge storm headed for the US real estate market. Legendary investor Warren Buffett is convinced that US real estate is about to experience a major crisis of debt. If you want to know what that means for investors, homeowners, and small businesses, make sure to like this video and hit that subscribe button, because you won't want to miss our expert insight on navigating these scary times. First up, bad loans and debt is causing a nosedive in property prices. Everything we do in the world of finance comes with consequences, and right now it seems like those consequences are catching up with us. The real estate market is sitting on top of $14 trillion of debt. Buffett believes this real estate bubble is about to burst, and the real impact will hit us sooner than we might think. In an interview, Warren Buffett and his right-hand man, Charlie Munger, talked about how American banks are sitting on a pile of bad loans, and property prices are suffering as a result. As far as commercial real estate is concerned, though, Buffett's company, Berkshire, is safe. This crisis will impact individual investors much more than big corporations. Confused? Let's figure out why. In the last 15 years, the real estate market in the US has been going crazy. Well, it's because of something called cheap debt. The idea of getting a loan when you want to buy a house. So if you're buying an office building for, let's say, $1 million, you probably don't have $1 million just lying around, right? You'd go to a bank and borrow most of it, for example, $650,000. Now, here's the catch. The interest rate on that loan matters a lot. Let's say it's 5%. That means every year you've got to pay 5% of that $650,000 loan as interest, kind of like how homeowners pay a mortgage. So in this case, that's $32,500 each year. It's a big deal in how profitable the whole deal turns out to be. So whether this property can handle that loan payment depends on something called net operating income. Think of it as the rent the property brings in, minus all the costs to own and manage it. Now, in our example, let's say this office building makes $60,000 a year for the owner. Great news, right? It means there's enough cash to pay off the loan. But here's what banks check. They use something called a debt service coverage ratio, or DSCR. It's like a safety measure for the property. To find it, you take the income the property makes, our $60,000, and divide it by the yearly loan payment, in our case $32,500. This gives us a DSCR of 1.85 times. Here's the thing, banks like to see a DSCR above 1.2 times. So our property is doing just fine with that low 5% interest rate. But hold on, things can change when interest rates go up. See, when folks buy homes to live in, they often get a 30-year fixed-rate mortgage. That means their interest rate stays the same the whole time. It's like a safety net, no surprises. But if you're a commercial property buyer, things are a bit trickier. See, commercial loan rates aren't fixed. Every 3 to 5 years, they reset to whatever the current rate is. Now, let's get back to our $1 million office building. If we bump the interest rate from 5% to 7%, the yearly loan payment jumps from $32,500 to $45,500. The property's financial situation just got tougher, but it's still manageable if the income stays the same. But what if we crank it up to 9%? Now the debt payment is a whopping $58,500. The $60,000 income can barely cover it. Okay, so keep in mind that remote work is making office space less popular. So let's say the income drops to $40,000 as tenants leave. Now the owner's in trouble. The income isn't enough to pay the debt, and foreclosure might be on the horizon. The bank might end up selling the building for way less than it's worth, and they'll take the hit. Just like Buffett said, buildings stick around, but owners might not. Here's how Buffett explains it. In real estate, many folks like to play it safe by using something called non-recourse loans. Basically, it means they can borrow money without taking personal responsibility. It's like saying, I'll take the cash, but I'm not personally guaranteeing anything. So imagine you're building a house to live in. You get a mortgage, right? Well, you have to sign something called a personal guarantee. That means you promise to pay the bank back, no matter what happens to the house's value. If your $400,000 home drops to $300,000, you still owe the bank the full $400,000. You can't just hand over the keys and walk away. Nope, they'll make you pay up, or you might end up in bankruptcy. So it's like two different worlds. One where people borrow without personal risk, and the other where homeowners are on the hook for every penny. And it's all playing out in this real estate drama we're seeing now. And if you're keeping up with everything until now, make sure to like this video and subscribe to the channel for more videos like these. You might think commercial real estate works like the home buying we talked about earlier, but it's quite different. Big properties like office buildings, apartment complexes, and warehouses are often bought with something called non-recourse debt. A big real estate company grabs a property for $50 million. They pitch in $10 million themselves and borrow the other $40 million from a bank using non-recourse debt. Now, fast forward a bit, and it's time for the loan's interest rate to reset. But here's the tricky part. The property's value has dropped to $30 million because it was bought at the peak when everything was expensive. Now, since it's non-recourse, the owner can just hand the keys back to the bank and walk away. Yup, the real estate company loses that $10 million they put in, but the bank is left with a property worth less than the loan. And because it's non-recourse, the bank can't do much but take the hit. This isn't just a theory, it's real. About $1.4 trillion worth of these loans are about to come due in the next year or two. And the scariest part? Many of these properties aren't worth what they were bought for, and they can't handle the bigger loan payments as interest rates go up. So, a big chunk of these places is headed for foreclosure when the bills come knocking. And guess what? We're already seeing it happen. Starwood, a massive real estate player, recently couldn't cough up $212 million for an Atlanta office building. This building was once prime real estate in a big, fast-growing US city. But now it's only 60% occupied, way down from 90% when they got the loan in 2018. The properties lost so much value that Starwood didn't even try to work things out with the lender. They just gave up and handed over the keys. And here's the kicker, this is just the beginning. More stories like this are on the way, and the fallout will go beyond just the real estate market. You'd think the big banks call the shots in real estate, right? Well, surprise, it's not the big guns. It's the small regional and community banks that take the lead. These little guys dish out around 2/3 of all commercial real estate loans. So, when the real estate storm hits, it's not the Wall Street giants who'll feel the heat. Nope, it's those smaller banks who lent most of the cash who'll have to face this crisis. But hey, don't panic and yank your money if you're with one of these small banks. Most should weather the storm just fine, and if any do go under, FDIC insurance has your back. The impact might not be a big bang, but more like a quiet ripple. Besides dominating in commercial real estate loans, these small banks are also the go-to for small and medium-sized businesses. While the big Wall Street players chase Fortune 500 giants, these local banks bet on the smaller businesses that power many towns and cities. Now, when these small banks take a hit from the real estate storm, they probably won't slam the brakes on lending altogether, but it's gonna hurt small and medium-sized businesses' access to loans. Without that cash, these businesses can't easily grow, hire, or spend, which puts a damper on economic growth. As for what's next in the real estate market, only time will tell. But one thing's crystal clear. Just like Charlie Munger said, there's gonna be some serious trouble. The question is, who's gonna feel it the most? So there you have it. Don't forget to hit that subscribe button so we can keep bringing you the best videos to become a top-notch investor by learning from the best in the business.